Welcome back to the channel. We have your market update for January 10th, 2025. We will discuss the non-farm payrolls report that came out today, other factors that go into that, the University of Michigan's consumer sentiment survey that showed a surprising surge in 5-year and 1-year inflation expectations, what your major banks are saying about this jobs report and what that means for future Fed policy, why markets are ultimately crashing, and why I think this is a buying opportunity. We also got a speech today from Fed Golsbee, and I will share his comments with you that don't really align with market consensus at this point. So ladies and gentlemen, let's go ahead and get into it. Hit the like button and subscribe to the channel if you are new here. If you learned something out of this video, sit back and enjoy the shit show, or at least the labor market. We came in at 256,000 job ads, way stronger than the estimate of about 164,000. Okay, so very strong jobs report. The unemployment rate was expected to hit 4.3%. It actually fell from 4.2% down to 4.1%. Average hourly earnings month over month came in line with expectations. That's actually good. Some people have called out average hourly earnings, people's wages are going up, so that could lead to more inflation, and that actually came in line with expectations, so that's good. Average hourly earnings year over year actually came in a little bit lower than expected at 3.9% versus 4% as was expected. Participation rate came in at 62.5%, same as the previous month. We were actually expecting that would go up to 62.8%. So not as great on the participation rate. Average weekly hours, same as expected, 34.3. Government payrolls, 33,000, higher than the expected 15,000. Manufacturing payrolls came in at negative 13,000 versus 29,000 as expected. And the non-farm payrolls private came in at 223,000 versus 135,000. So that was much stronger than expected. The U6 unemployment rate came in at 7.5% versus estimates of 7.9%. And this is the U6 unemployment rate is people who want to work but have given up searching, and those working part-time because they cannot find full-time employment. This is a 6-month low at 7.5%. So yeah, overall, if you want to just sum it up in one picture, strong jobs report. Now, there's some people that point out it was really just part-time jobs. Full-time jobs actually fell over 300,000 for this month. Yeah, that's true. This report's not as strong as it looks like, but Wall Street only cares about what it looks like. So there's really no sense in trying to say that this was not a strong jobs report. It wasn't. If you actually look at full-time jobs, it was a weak report. But Wall Street doesn't care about that. They just care about these headline numbers. So what Wall Street cares about, it was a strong jobs report. What I think is also adding the 1-2 punch to this is the Michigan consumer sentiment. Okay, Michigan consumer sentiment came in lower than expected on the headline number at 73.2 versus estimates of 75. But look at this. 5-year inflation expectations were expected to rise from 3% last month up to 3.2%. They actually went to 3.3%. Okay, this was the steepest rise in 5-year inflation expectations since when? June of 2008. Let that sink in. This was the steepest rise in 5-year inflation expectations since June of 2008. Yeah, it's been a long time. Okay, now June of 2008, let's go ahead and pull up this whole period here. Boom. You're at 3.4%. So you actually went a little bit higher than where we were. And then what happened? You actually started to obviously come down as we were going into the 08-09 recession that really took more precedence heading into 2009. People are like, oh crap, yeah, this is going to be bad. Inflation expectations actually came down to about 2.6%. Now, this data, it doesn't tell you too much about what inflation's actually going to be. Okay, if you look at this over time, and I know people are paying a lot of attention to this, the 5-year inflation expectations, but if you actually look at this over time, it doesn't tell you too much. Okay, you've been high, okay, since 2021 you started going higher, and it's been at very elevated levels, even though inflation has been coming down. So even though it just spiked up, doesn't mean that we're just guaranteed gonna have a higher round of inflation. And that's essentially what the markets are saying today. The markets are saying today, via the jobs report, via the 5-year inflation expectations, and the 1-year inflation expectations came in hotter than expected at 3.3%. Last month was at 2.8%, so that was a huge rise. We were expecting 3%. So 1-year, 5-year inflation expectations, all of it went higher today. But none of it really means that we're going to get inflation. Okay, what this is reacting to, let me just spill the beans for you, is Trump tariffs. That's what this is reacting to. Because people just have heard Trump's going to cause inflation with his tariffs. So we expect higher inflation. That's all it is. Okay. Did you know, in fact, the last CPI report, if you exclude housing, was negative 0.47%? And you can see this with 10-year Treasury yields today up about 8 basis points to about 4.76%. We've seen this dramatic rise in 10-year Treasury yields based on expectations and not reality. Okay, this rise in 10-year treasuries is based on inflation that's going to go higher, based on tariffs that have not happened yet. So question is, do we get these inflationary tariffs? Or is it something that is not as bad as feared? I think the odds have dramatically shifted towards this is probably not going to be as bad as we expect. Okay, so I think you are setting yourself up for a buying opportunity. I think right now is a buying opportunity. But I do think after the inauguration on January 20th, people are going to look around and say, oh, wait, it wasn't as bad as we thought. Maybe the tariffs aren't going to be as crazy as we thought. Consider this for a moment. For the first time ever, a U.S. president-elect, in this case Donald Trump, has invited China's President Xi to his inauguration. Now, Xi is not going to the inauguration, but he is sending a senior executive, if you will, of the Chinese government to attend Trump's inauguration. So basically about as good as it's going to get, right? Okay. You really think there's going to be this global trade war with the U.S. and China? Trump just, invited his trade war enemy, if you will, as Wall Street is thinking about this, to his inauguration? Probably not. Do you think tariffs are really going to be as bad as expected? Probably not. Trump's going to say, okay, China, we have to tariff this area. It's really not important to our economy. And maybe it's the car market, right? China doesn't sell cars in our market. Tariff the hell out of that. Doesn't matter. In exchange, you're just going to buy some soybeans from us, or you're going to do this from us. China's going to say, yep, no problem. Trade war over with. No more tariffs. In that case, we have priced in a lot of inflation when nothing will actually happen. That, mark my words, is going to happen. It's going to be a whole lot of fear for nothing to eventually happen. Because, again, back to basic principles, does Trump want to be the guy that ended the bull market? Does Trump's legacy want to be one of he came into a strong economy and ruined it? He came into an economy where inflation was falling and skyrocketed inflation. No. Just think about that from a commonsensical standpoint. No. Okay? So Wall Street has run away with expectations. Wall Street right now feels like a hypochondriac. Okay? We're all concerned about inflation, about, this is going to lead to inflation, this and that, and a strong jobs report means we're definitely going to get inflation. No, it doesn't. Sounds very hypochondriacal, if that's a way to put it. Now, what's important will be next week's inflation data. Now, if inflation spikes, then we might have a little bit of a problem on our hands. Tuesday, we have our PPI report expecting 0.3% month over month, actually lower than the 0.4% that we had last month. Core PPI expected to stay stable at 0.2%, same as last month. On Wednesday, we have our CPI report expecting 0.2% on a month over month basis for core. Last month was 0.3%. So general expectations on Wall Street are actually that inflation is going to come down from last month's month over month rate. Core year over year is expected at 3.3%, the same as last month. Inflation on a headline basis month over month is expected at 0.3%, the same as last month. And year over year headline is expected at 2.8%, up a little bit from last month's report at 2.7%. So, we probably don't have this inflation problem on our hands. Okay, even the expectations for next week, they're not for that much like inflation. Basically kind of in line with what we had last month. So what does that mean? That means the rise in treasury yields right now is not even really based on fears of next week's inflation report, but it's based on inflation reports via tariffs, after tariffs, that again have not happened yet. So I cannot stress this enough. Wall Street is going to be wrong on this. We are not going to get this big round of inflation again based on tariffs. Now, it would be understandable to price in a little bit of a concern, but to throw the kitchen sink at the narrative of we're going to have higher inflation based on a strong economy and tariffs is going to be a dramatic mistake for anyone that is buying into that. And that is why I think this is a great buying opportunity, because in all reality, in 2025, I think we're going to have lower than expected inflation. Okay economy, not great, but not terrible. Under that circumstance, the Fed's going to be cutting rates multiple times in 2025. Now, as of today, Wall Street is expecting the first Fed rate cut of 2025 in October. Okay, in October. You can see here, that's the next expected Fed rate cut, currently priced in with 40.5% odds to drop rates to 4 to 4.25%. Wow. What do you think are the odds of us not getting a rate cut until October? I think there's really good chances at this point over the next couple of months we could actually price in a rate cut. What about June? We could get a cut in June, and maybe that would be a positive surprise to markets to get a cut 6 months from now. Now, we do have some comments from Fed officials. Fed Golsbee says the inflation rate over the last 6 months was 1.9%. Fed Golsbee says if conditions are stable and there is no uptick in inflation with full employment, rates should go down. He says 12 to 18 months from now, rates would be a fair bit lower if current expectations are met. He says the Fed does have to think about issues like tariffs and other nations' responses that impact prices. Fed Golsbee says the issue would be determining if tariffs are a one-time shock to prices or a persistent one. Fed Golsbee says once there are concrete proposals, the Fed will have to think about how they impact the dual mandate goals, which is how it should be in general. We shouldn't be speculating on what's going to be tariffed and what the tariff amount's going to look like. I mean, you just can't teach this stuff in school. And I think that's where the Fed is messing up. By the time we actually get the tariffs that are announced, they're going to be far more benign than the markets are currently pricing in. Fed Golsbee also says it is wrong to say not making progress on inflation. And that's true. We have been making progress on inflation. And if next week's CPI report confirms that, then all of a sudden we're going to say, oh, wow, we have a strong economy with inflation that's continuing to fall. Okay, that's a good thing, right? That's what's so asinine about today is the labor market has very little to do with anything in regards to inflation the last couple of years. I mean, inflation spiked with a strong economy. Inflation fell with a strong economy. There's no right answer here. Whether the economy being strong or weak actually impacts inflation in and of itself. We have no evidence of either or. So I don't fall into that bandwagon that a strong economy means higher inflation. That is absolutely not a guarantee. Fed Golsbee says, so far I do not see evidence of overheating in recent months, because we're not. And that's in terms of the economy. Fed Golsbee says interest rate sensitive parts of the economy do show the impact of Fed restraint, even if that is offset by things like business confidence. Fed Golsbee said it would be a concern if long rates started rising on the basis of inflation expectations. Buddy, where are you? Where have you been the last 2 months? Rates are rising based on inflation expectations. That is what is happening. 10-year Treasury yields are moving higher on inflation expectations. But it's tariff expectations that are causing it, which haven't happened yet, which are theoretical. Here's what major banks are saying about this jobs report, and as well as, tariff expectations being asinine. The major Wall Street banks are full of shit. They just don't understand how economics work. They don't understand that we don't know what tariffs are going to look like. We don't even know if tariffs will be inflationary. We don't know if a strong economy will prevent the Fed from cutting rates. It really just depends what inflation does. Now, Wells Fargo says an interest rate cut by the Fed in March looks increasingly unlikely. Bank of America says we no longer expect more Fed rate cuts. So the rate cutting cycle is over with because we added 256,000 jobs last month. Do you know how crazy this sounds? That one data report just ruined everything. Bank of America's global research says, quote, we think the cutting cycle is over. Our base case has the Fed on an extended hold, but we think the risks for the next move are skewed towards a hike. You can't make this up. You really can't make this up. Again, this sounds like hypochondriac-like activity. Okay? That because this is happening, everything else is going to be much worse, and throw in the towel. It's over. Okay? If anything, we're going to get a hike next. Give me a break. We haven't even gotten inflation data. We don't even know what the tariffs are going to look like. And that's why I'm so bullish right now. Because when you have Bank of America saying the cutting cycle is over, the base case is the Fed's on an extended hold, which will be at least all of this year, and that if before we get another cut, we're more likely to get a hike. When you have this kind of narrative going around, when nothing has really changed besides the economy is stronger than we thought, which is a good thing, by the way, you have a much greater chance of upsetting those expectations, that inflation comes in low, or tariffs are not as bad as feared, and we get a rate cut. I mean, how unconsensus would that be at this point to get a cut in March if inflation continues to fall the next 3 months? How unconsensus would that be? Very. Nobody's expecting that. Citigroup expects the next Fed rate cut in May, previously saw January, and that, again, could make some sense if inflation remains kind of sticky, if we don't continue to see further progress on inflation. Bank of America's Capistrán rules out the U.S. 25% tariffs on Mexico in the short term. Goldman Sachs expects the Fed to deliver a total of 50 basis points of cuts this year after the non-farm payroll data versus the prior forecast of 75 basis points. Morgan Stanley, one that actually has their head screwed on, right, says a March cut is still more likely than not due to its more favorable inflation outlook. Again, that's correct. I think a favorable inflation outlook. I mean, if we see progress on inflation from here, the Fed will still be cutting rates. A lot of people forget that it's a dual mandate here. If inflation comes down, that's good, right? If inflation comes down, there's less risk of inflation, and you can afford to cut rates, especially when 10-year Treasury yields are this high, really restricting the economy. It makes your dual mandate even more important to protect the job market. Now, taking a look at broader metrics in our markets, the percent of stocks trading above their 50-day moving average is at 27.26%. That means 73% of stocks are in an active decline. This is about as bad as it gets during a bull market. Could it get worse? Yes, you could fall to like 20% of stocks trading above the 50-day moving average, but this is really bad. Unless we are going into a new bear market, you want to be buying this dip right now. CNN's Fear and Greed Index today is at 27, which is almost an extreme fear. Again, anytime you're in a bull market and sentiment is in extreme fear territory, you want to be buying that, okay? Question is, do you think we're going into a new bear market? Do you think stocks are screwed at this point? Let me know down below in the comment section. And same is true with the AI Investor Sentiment Survey. You're almost at a one-year bearish high for sentiment. You were at a one-year bearish high on November 27th, 2024. Currently, you're at 37.4% of investors that are bearish, 28.0% of investors that are neutral, and 34.7% of investors that are bullish. So 3% higher bullish percent here than bullish percent. That's pretty extreme. Now, the S&P is down about 4.5% from its all-time high. It looks like you're bouncing at this 100-day moving average at about 578. You're bouncing up a little bit. If we don't hold support here, then we're going to fall to that 200-day moving average. It's 50-50. Sometimes you bounce around this 100-day moving average. Sometimes you got to flush lower than that. So if we do, your 200-day moving average would be the next place that we would visit. Okay, and hopefully it would be just a visit. Hopefully it wouldn't be prolonged in nature. If that's the case, then we have a huge problem on our hands. Now, the RSP is down about 7.5% from all-time highs, with, again, the average stock that has gotten absolutely decimated in recent weeks. Small caps, cyclicals, value, industrials. Big tech has kind of held up our markets a bit. But the average stock is down quite a bit. It's not too often 73% of stocks are in an active decline. So what does this mean? What is the bottom line from today? The economy is doing okay. The labor market is strong. Does that guarantee inflation? No, it doesn't. I don't know who needs to hear that. But the labor market being strong does not guarantee inflation. Expectations of inflation are rising because of Trump tariffs that haven't happened yet. So, as I say on this channel all the time, stocks move for two reasons. Number one is expectations. Number two is earnings. Okay, bottom line, it's always about earnings long term. Okay, long term earnings matter. In the short term, it's all about expectations. And I try to think of things on like a line chart, maybe. If in the middle is neutral, on this side over here is bullish, this side over here is super bearish, right? we're like way over here right now. Like everything's bad. Inflation's going to skyrocket. At least that's what the 10-year treasury yields are telling us right now, almost at 5%. Trump tariffs are going to be super inflationary. The economy is going to do fantastic. That is kind of where we are right now. Whereas in the middle would be inflation slowly starts to fall. Trump tariffs are not that inflationary. Maybe they're a net neutral overall, and the Fed could cut rates once or twice this year. The super bullish side would be inflation's coming down. Maybe it's plummeting. Trump tariffs don't happen, or they're not inflationary at all, and the economy is okay. That's like the very bullish side. Fed cuts rates like 4 or 5 times this year. We're way over here. So what are the odds that we could start to get back to more of a neutral place in the coming weeks? That maybe we realize Trump tariffs are not going to be as extreme as we think, and inflation is still making progress. It's not plummeting. It's not going straight down, but we're making progress, and the labor market's strong. If we could swing back from a super bearish position like we are now to more of a neutral stance, that could really allow the markets to rally here. Okay? And I would bet on that versus getting more negative. That tariffs are even more extreme than we think. That inflation's going to be an even bigger problem than we think. That the economy is overheating again. That is what it takes from here, I think, to get even more bearish. For sentiment to get even worse. I think the odds are ever in your favor. That things do not get much worse from here. Could be wrong there. Maybe Trump wants to end the bull market. You know, who knows? I don't know the guy that well. I don't know the guy at all. Maybe his ultimate master plan was to come in and ruin people's 401ks and prevent people from retiring. And maybe he's this big sinister guy that hates America, that hates the bull market. Nothing would suggest that. Okay, so to say that Trump's gonna come into office and cause all of these problems for America, for the business cycle, I don't buy it. Sorry. If you're a bear right now, you're buying into that, at least somewhat. That Trump's gonna be this huge issue, huge negative for markets. Trump tariffs are gonna be super inflationary, so on and so forth. I just don't buy that. So I don't buy that. That means I'm buying the dip in our markets. I do think it's a great time to be buying the dip, especially if you have not done so already. I think the worst of it is behind us. But next week's inflation report will be absolutely critical. Because if inflation goes higher, yeah, you're going to be in an even bigger problem. That's a guarantee. That's a certainty. Especially with the strong jobs report that we just got today. So let me know what you guys think about this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.